Welcome to the next session on commodity derivatives and risk management, and today we would like to discuss different aspect of commodity indices. All of you must be knowing how regular stock indices are calculated and reported by different stock exchanges. For example, every day around 9:30, those of us who would like to know how the India's stock market is performing, we would like to know what is the value of the Sensex or how Sensex has moved vis-a-vis yesterday's Sensex value. So before I go into the discussion of how commodity indices gets calculated, let's spend maybe couple of minutes understanding how stock indices are calculated. So let's say all of us we know Sensex is the diversified index reported by Bombay Stock Exchange. We know that Sensex has 30 constituent companies. These are normally large cap, diversified big companies, and Sensex is calculated based on market capitalization weight. So it's calculated based on market capitalization weight. Let's take a numerical example. So let's say instead of 30 company, let's say index has 4 companies. So company A, company B, company C, company D. Let's say the price of the company A is, let's say 120, company B is 55, company C is let's say 33, company D is let's say 1750. So this is the price of shares, each share of these 4 companies. Now because these are market capitalization weight, we have to find out what is the market capitalization of each of these company. So how do we find out the market capitalization? So the market capitalization will be calculated as number of shares. So let's say number of shares for company A is N1. So you have N2, N3 and N4. So this N1, N2, N3, N4 is the total number of free float shares which are available for trading for that particular company. Let's say for could be company A, it could be 3 lakh shares, company B it could be 50 lakh shares, company C it could be some 7 lakh shares. So depending upon the number of shares which has been issued by the respective company and the number of shares which are freely available for trading. So this N1, N2, N3 we will be getting that value, and N1 multiplied by let me pick it make it P1, P2, P3 and P4. So you have, this is the number of shares. Market capitalization will be N1 into P1, N2 into P2, N3 into P3 and N4 into P4. So let's say M cap 1, M cap 2, so on and so forth. Let's say M cap 4, and we sum all these MCAP. Market capitalization I equal to 1 to 4, that is going to give the total, this is going to be total market capitalization. So that is going to be total market capitalization. Now how do we then get to know what is the index value? Let's say yesterday total market capitalization was let's say 600 crore. So yesterday's MCAP T minus 1 is 600 crore and Sensex value was around, let's say, 24,370. So this is the Sensex value of yesterday with yesterday market capitalization. Suppose today's total market capitalization is 647 crore. So now we will be able to find out if 600 crore was equivalent to 24,370, what is going to be the Sensex value with 647 crore. So this is how the different exchanges report the equity indices. In fact, every stock exchange has its own broad based equity indices, as well as every exchange also is publishing different sector specific indices like BSE Auto, National Stock Exchange, Pharma, different, depending upon different industrial sector, there are different kind of indices are published by the exchanges on a daily basis. In fact, now exchanges are also reporting these indices on real time basis. As and when the underlying constituent share price is changing, the indices values are getting changed, and exchanges are calculating and reporting these indices on a real time basis. So this is briefly about the stock indices or calculated and reported by different exchanges. Now Now let's go to the today's agenda of how commodity indices can be calculated and how exchanges calculate and report these commodity indices. One thing I would like to tell here very clearly is that these commodity indices predominantly are for futures. They take into consideration the underlying futures value, and a composite index is calculated by considering the futures value. Exchanges also report commodity spot indices, but right now let's focus on understanding how commodity exchanges prepare or calculate and report the different indices. As I mentioned, let's focus on the PPT. As I mentioned, a commodity index measures the price movement of commodity futures contract constituting the index. So some of the indices I have mentioned here, and commodity indices are quite a few in the sense you have maybe at this point of time, if Bloomberg publishes around 100 commodity indices constituting of futures contract of different underlying. So in this particular slide I have only listed out some of the indices. So let's what are these indices? S&P Goldman Sachs commodity indices. So Dow Jones UBS commodity indices, and Deutsche Bank liquidity commodity index, Roger International commodity index, Reuters CRB commodity index, and MCX Comdex and NCDEX Dhanya. So these are last two commodity indices are prepared and circulated by Indian exchanges, commodity exchanges, that is MCX and NCDEX respectively. Now all equity indices, almost all equity indices which are reported by different stock exchanges like your Sensex, Nifty, S&P 500, FTSE 100, all ordinaries or Nikkei 225, all these indices follow the same methodology. Almost all exchanges have the same methodology of calculation. However, commodity futures index calculation can vary from one index to another index. In today's session, we will understand what are the different ways of how these commodity indices are calculated. Let me go to just take you an example of which commodity futures contract are part of the S&P S&P Goldman Sachs Commodity Index. So you have, if you can see the detail which is given in this screen, it has got commodity futures contract trading from 5 different sectors, that is energy sector, industrial sector, precious metal, agriculture and livestock. So you have in the energy sector, you have crude oil, Brent oil, RB, OB, gasoline, heating oil, gas oil, natural gas, etc. So it's a time for little trivia. Please find out what is the full form of RBOB gasoline. What is the RBOB gasoline? As you may be knowing, gasoline is nothing but our petrol, and so what is this RBOB stands for? Okay, this much for the time being I can say is that RBOB gasoline is equivalent to only dead petrol. So nevertheless, what is the full form of RBOB? Please visit the website and find out what RBOB stands for. Okay, now continuing with our discussion on different constituent commodity futures as part of the S&P Goldman Sachs. If you see, among the industrial metal category, you have aluminum, copper, lead, nickel, zinc, of course like precious metal, gold, silver, agricultural, different agriculture futures are mentioned. In the livestock category, you have live cattle, you have feeder cattle and lean hogs. One thing I would like to mention here, that in Indian commodity exchanges, none of the this livestock futures contract trade. There is some difference between live cattle and feeder cattle. And what is the difference? Live cattle are those cattle which are ready to be slaughtered and to be whose meat can be are boxed and sold in supermarket. These are basically the beef which are consumed by most American people. And feeder cattle are the calves which are not yet ready to be slaughtered. They are sold as part of the futures contract, and they go to a place called a feedlot, and there they stay for 8-10 months and attain the desired weight, and then only these feeder cattle are known as a live cattle. And lean hog is, of course, there are nothing but we in India we call them these animals as pig, and for producing pork. So now let's go to another commodity index, that is Rogers International Commodity Index. So this commodity index has been created by an individual. Unlike the previous commodity index, S&P Goldman Sachs commodity index, which is maintained by S&P Goldman Sachs jointly, you have Rogers International Commodity Index is maintained by an individual called Jim Rogers, very interesting personality, and he has a tremendous amount of experience in commodity trading. If you are interested to know more about Jim Rogers, you can go to YouTube video and see some of his views on where the commodity prices are going to go and all. Very interesting way of analyzing the fundamentals of a particular commodity. Now this Rogers International Commodity Index again consists of agricultural, livestock, energy, metal, and one of the important distinction between S&P Goldman Sachs Commodity Index and this RISI index is that RISI index considers the futures contract traded in majority of exchanges all over the world. So So if you can see, the RISI considers 37 commodity futures traded at 9 different commodity exchanges. However, Goldman Sachs considers only those futures contracts which are traded at Chicago Mercantile Exchange. Now, going back to our discussion on different kinds of commodity indices, there are commodity indices can be created with 3 different parameters. So what are these 3 parameters? So each index is maintained by a index committee, and each index has an advisory body. So the advisory body has to decide which commodity futures contract are to be part of the index. So there has to be, let's say in India, NCDEX, you have around 60 different commodity futures contracts are traded. So the next question is that should these 60 be included into the index, or some less number of futures contracts are to be included in the index. So what should be the methodology for selection of commodities to be part of the index? Now the second aspect is the having selected a particular futures contract, what should be the weight of that particular commodity future in the index. Now another very interesting dimension of a commodity index is that commodity indices are based on futures contracts. And all of us, we know futures contract come to an maturity or expiry at some point of time. So if suppose a near month futures contract has been used to calculate the index value as on today, after some point of time that contract is going to an end. So the next question is, how do we take into consideration this aspect? So this is done through a mechanism called index rollover. So at times you can have a commodity futures index which will not be rolled over, but majority of commodity indices have a rollover mechanism inbuilt into it. So what exactly is a rollover mechanism, and how commodity selection is done, and how calculation of weights are done, we will be discussing right now. Going to the selection of commodities, it is normally based on the liquidity of the contracts traded at a given exchange or a set of exchanges. So it depends upon the index advisory committee. As I mentioned, S&P Goldman Sachs Commodity Index only considers commodities futures which are traded at CME. However, RISI considers commodity futures contract traded at 9 different exchanges, and these commodity contracts are also priced in different currencies other than dollar. So all these have to be decided by the index advisory committee. Now the second aspect of decision which the index advisory committee has to take is with respect to the weights of the future contract. Let's say the Index Advisory Committee decides that crude oil futures contract is definitely going to be part of an index. Now the question is, along with the crude oil, let's say the Index Advisory Committee decides 10 other futures contract, let's say gold, soybean, maybe cadmium, almond, so on and so forth. Now the next question is how the weight has to be calculated, or which weight will be given to the futures price to arrive at the index value. Normally, as this slide you can see, the weights of the futures contract is based on world production weight or liquidity, based on the liquidity, or based on world production and liquidity, or equal weight. And when it comes to world production is that what is the total amount of that particular commodity which has been produced in the world, what is the total production of in the world. So the Index Advisory Committee has to keep track of what is the total production which has happened. Of course, if only 1 year production value is considered for calculation of weight, then a year which has got a extreme value in terms of very high production or very low production, so that year that commodity may have a higher or lower weightage. To smoothen out this variability in the production value, the Index Advisory Committee normally takes the average of the last 4 to 5 years of production on a rolling basis, and that becomes the weight for a commodity. Now the second weight which can be considered is the liquidity. Many times only consideration of world production as a weight can lead to a distorted value of a futures contract. For example, let's say gold production will be around some X number of tons. It won't be more than maybe annually it could be, total gold production would be some 800-900 tons all over the world. But if you compare this one with, let's say, steel production, it could be thousands and thousands and thousands of tons steel which is getting produced, or copper which is getting produced, thousands of tons of copper which is getting produced all over the world. So going by, if we only consider world production as a weight, then we will be giving we will be underweighing gold vis-a-vis the copper or steel. So that could be the reason why many commodity future contracts consider world production as well as liquidity for calculation of a weight. So what do we mean by liquidity? Liquidity is the total number of futures contract traded at a given exchange. So if let's say RISI has considered Azuki beans which is traded at Tokyo Commodity Exchange. So the total traded volume of Azuki beans at Tokumo will be considered as the liquidity. Similarly, let's say if RISI has considered wool futures contract traded at Australian Stock Exchange, so the total volume of futures contract traded at Australian Stock Exchange will be considered as a liquidity, and a respective weight will be calculated. So as you can see, the third measure of weight could be world production and liquidity combined together, and the fourth one is the equal weight. So now let's go to the next concept, which is the index rollover mechanism. So how indices gets rolled over? All of us we know that these commodity indices consider futures contract as the constituent entities. commodity indices constitute futures contracts are constituent entities which expire. Now, how an index can be calculated? Also, not only one contract matures, different contract mature at different dates. Let's say if a index has been calculated, index considers 4 commodity future contract, let's say gold, silver, almond and jeera. So gold may be maturing on 20th of the month, and silver may be maturing 10th of the month, jeera may be maturing last calendar day of the month. So considering different maturity dates, how this index can be calculated. Now let's take a numerical example. A contract gets rolled over from the nearby contract to the next nearby contract. So when index is getting calculated, a contract gets rolled from a nearby contract to the next nearby contract, and the index advisory committee clearly specifies the rolling period and the rolling mechanism in terms of the rolling rate. So let me repeat. The index advisory committee very clearly specifies what is going to be the rollover mechanism in terms of from which date the rollover will start and the rate at which rollover will happen. So when we are talking about the word rollover, means the contract, the nearby contract will be shifted from the nearby contract to the next nearby contract. Suppose an index only considers the M1 contracts. So M1 contracts are there, that is the contracts which are there for the near maturity, and for calculation of the index before the maturity of a particular underlying futures contract, the price considered shifts from the nearby futures price to the next nearby futures price based on a rolling standard rolling mechanism. So in the next session we will be discussing in detail how this index rollover mechanism happens with a example. And let me summarize what we discussed today. How equity indices are calculated and reported by stock exchanges. In case of equity indices, the companies do not change on a daily basis. Yes, companies do change in the sense whenever there is a merger acquisition happens, a company gets gets removed, company cease to exist. That point of time a company gets removed, and many a times based on the internal guideline of which company can be part of the index, in a company may be removed from the index and a new company may be added in the index. But that happens only very infrequently, maybe 2-3 times a year. In the sense 2 or 3 company may be getting added to an index and 2 or 3 company getting removed from the index, considering, let's say, if the index constitute 50 or 60 companies. If you have a bigger set of companies constituting in underlying index, let's say S&P 500, maybe the number of changes could be little higher. However, in case of a futures contract, futures indices which are consisting of future contracts which mature very frequently, the indices have to be rolled over from nearby contract to the next nearby contract. We also discussed how the future indices will be based on the world production weight or liquidity weight, based on liquidity weights, or based on world production weight or liquidity weight, or it could be equal weight. Now with this we'll end this session, and looking forward to interacting with you all in the next session. Thank you all of you.